Welcome to this explainer, where we're going to completely break down the massive and frankly pretty complex 2026 changes to reverse mortgages. Look, whether you're eyeing your home as a retirement safety net or maybe you're just looking for a way to bridge an income gap, you need to know that the landscape is shifting dramatically. Today, we're going to rely directly on official HUD data, some very urgent new IRS warnings, and expert financial analysis to help you navigate these waters. We're sticking strictly to the source materials here to give you a clear, structured, no-nonsense look at exactly what's changing, what is absolutely at risk, and how you can prepare yourself.
Okay, let's just dive right into the deep end with the number that's making major headlines right now. A record-breaking $1,249,125. For the year 2026, the U.S. Department of Housing and Urban Development, HUD, has significantly raised the ceiling for how much of your home's value can actually be considered when they calculate a federally insured reverse mortgage. And we can see the exact proof of this right here in the official HUD Mortgagee Letter 2025-22. This is the literal document establishing the new maximum claim amount for home equity conversion mortgages, which you'll usually just hear called HECMs. This represents a nearly $40,000 jump from last year's cap, which set around $1.209 million. Now, what's really fascinating here is that this new limit applies nationwide. So whether you live in a standard cost of living area or you're in high-cost zones like Alaska, Hawaii, Guam, or the Virgin Islands, this is your new baseline. It opens up some truly incredible new borrowing power, especially for senior homeowners who have watched their property values absolutely surge over the last few years.
Now, because reverse mortgages are somewhat notorious for their fine print, here is our roadmap for today. We'll cover the 2026 boom, why the IRS is suddenly watching, the mechanics and mandatory counseling, navigating spousal protections, and finally, making the right choice.
Section 1. The 2026 boom, record limits and market forces. Let's start with exactly what is driving this surge and why it matters so much to your financial toolkit.
So the basic formula for reverse mortgage access is currently working heavily in favor of borrowers. We're seeing a slow, steady decline in interest rates from their recent highs, and that's combined with home values that have just stayed remarkably elevated across a lot of the country. As the data points out, you don't just qualify for a flat, arbitrary dollar amount when you get a reverse mortgage. You qualify for a percentage of your home's appraised value. And because that percentage is so heavily influenced by interest rates, when those rates go down, the amount of money that actually becomes available to you goes up. It actively increases. This dynamic is completely transforming the reverse mortgage. It's honestly no longer just a last resort loan for seniors in financial distress. It's becoming a highly flexible, strategic financial tool used to maximize retirement resources.
Section 2. The IRS is watching urgent tax reporting rules. Because, as you might have guessed, with more money comes more government oversight.
For decades, tapping into your home equity was a pretty private matter between you and your bank. Well, not anymore. The absolutely crucial point here is this rapidly approaching timeline, May 1, 2026. That is the deadline you need to circle in red on your calendar. Starting on that exact date, lenders and closing agents will be legally forced to report your equity withdrawals directly to the Internal Revenue Service. Before you even sit down to file your tax return, the IRS is going to have a complete automated picture of the funds you've accessed from your home. So the time to gather your documents and consult a tax professional is right now before this whole automated system kicks into gear.
Let's look at exactly what the government is tracking here. To close what they've identified as billion-dollar tax compliance gaps, the IRS has mandated that 3 specific financial activities tied to senior homeowners will now automatically trigger reports. First, they're looking at reverse mortgage disbursements, and that means both the big lump sums and the smaller monthly payments. Second, they're tracking home equity loans and lines of credit, specifically where the borrower is over 62 and the loan exceeds a certain threshold. And third, they are monitoring select property sales that generate a reportable gain. The underlying data showed the government that senior homeowners were actually one of the most underreported demographic segments out there. Sometimes this was just due to honest, simple mistakes, and sometimes it was deliberate. But either way, the government's response is this strict mandatory lender reporting system.
Now, let me be very, very clear about this next part because it's confusing for a lot of people. Reverse mortgage proceeds themselves are generally not taxable income. The IRS essentially views these advances as debt. It's a loan against the equity you already hold in your home. However, here's the catch. If your lender reports to the IRS that you received, say, $50,000, and the IRS's automated computer system doesn't see that accounted for perfectly on your tax return, it can easily trigger an automatic audit flag. Furthermore, if you take those non-taxable loan proceeds and you put them into an interest-bearing account or you use them to generate investment income, that secondary income is absolutely taxable. The big takeaway here is that the burden of proof is shifting from the IRS over to you. You literally must ensure your paperwork is immaculate so that an innocent little discrepancy doesn't spiral into a multi-year audit with penalties and interest.
Section 3. Mechanics and Mandatory Counseling. Now that we understand what the IRS is suddenly looking for, we really need to dig into how these loans are actually built to protect you as a consumer.
At the very core of any reverse mortgage is something called your principal limit. This is the magic number that dictates your exact access to cash, and it is meticulously calculated based on three things: the age of the youngest borrower, the current interest rate, and the appraised value of the property up to that $1.249 million FHA limit we talked about earlier. The basic rule of thumb to remember is this: the older you are, the more equity you can unlock. And conversely, if interest rates drop, your principal limit generally goes up.
And understanding that principal limit brilliantly illustrates one of the massive benefits of the federal program. It all comes down to what the industry calls crossover risk. See, because a reverse mortgage is what's known as a rising debt, falling equity loan, your loan balance naturally grows over time while your remaining equity shrinks. Crossover risk is that specific, critical moment when your loan balance actually exceeds the total value of your property. But here is the good news. FHA insurance on a standard HECM protects both you and the lender from this exact scenario. Because of this powerful federal backing, lenders feel secure enough to offer you higher initial principal limits. On the flip side, proprietary private reverse mortgages often have to set much lower initial limits. They have to do this to protect themselves against that crossover risk because they simply don't have that government insurance wrapper protecting them.
Because these mechanics are undeniably complex, HUD strictly requires mandatory counseling before you can ever close on a HECM. There is no getting around this. You must meet with a HUD-certified housing counselor who is going to walk you through a rigorous protocol. And they won't just explain the loan, they're actually required by law to discuss alternative options with you, things like downsizing or seeing if you qualify for other social services. They must disclose the tax consequences and how a reverse mortgage might impact means-tested programs like Medicaid. But most importantly, they will drill into your absolute non-negotiable responsibility to continue paying your property taxes, your homeowner's insurance, and your basic home maintenance. If you fail to pay these basic property charges, the loan becomes due and payable immediately. And yes, you can absolutely face foreclosure.
Section 4. Navigating Spousal Protections. Let's look closely at one of the most misunderstood and, frankly, most dangerous areas of reverse mortgages. What exactly happens to the spouse who isn't on the loan?
Real life happens, right? And sometimes only one spouse actually applies for the loan. Maybe the other spouse just isn't 62 yet, or for whatever reason, they aren't on the title of the house. HUD strictly categorizes this second person as a non-borrowing spouse. But the absolutely critical distinction you have to understand is whether HUD considers them eligible or ineligible. An eligible non-borrowing spouse is someone who is legally married to the borrower at the time of closing, their marriage is fully documented, and they currently live in the home as their primary residence. If the borrowing spouse passes away, that eligible spouse is granted a deferral period, allowing them to stay in the home. An ineligible spouse, on the other hand, does not meet these criteria. If the borrower dies, there is zero automatic right to remain in that house. The loan becomes due and payable immediately, and the estate must either repay the loan, refinance it entirely, or sell the house.
And listen, it is so vital to understand that even an eligible status isn't just a free pass forever. An eligible non-borrowing spouse can instantly lose their deferral protection and face the loan coming due if they fail to meet ongoing obligations. If they stop paying the property taxes, if they let the homeowner's insurance lapse, if they let the physical property itself fall into deep disrepair, or if they permanently move out, say they have to transition into a long-term care facility for more than 12 consecutive months, those protections vanish. Just like that, the deferral period ends and the lender will call the loan.
Section 5. Making the right choice, strategy, and the endgame. With record limits, tax oversight, and strict spousal rules defined, let's wrap this up with a strategic checklist you need to navigate this landscape safely.
First things first, you really must assess your baseline eligibility and your personal financial discipline. Do you and does your property actually meet FHA standards? Are you 62 or older? Do you have no delinquent federal debt? And are you actually living in the home as your primary residence? But beyond the paperwork, you need to look in the mirror regarding your own discipline. If you open a HECM as a growing line of credit, it acts as an incredible, flexible emergency fund. But do you have the restraint to manage that access to cash responsibly, especially keeping in mind those new automated IRS tracking rules we discussed earlier? Next, you need to coordinate this loan with your broader retirement goals. A reverse mortgage is just a tool, it's not the outcome itself. Many seniors are utilizing a HECM to completely eliminate their traditional monthly mortgage payment, which frees up massive amounts of monthly cash flow. Others use it strategically to bridge an income gap so they can delay taking Social Security, which allows those federal benefits to grow substantially larger. Or you might use a HECM growing line of credit as a kind of buffer asset, meaning you draw from it when the stock market is down, which protects your traditional investment portfolio from something called sequence of returns risk.
Furthermore, you absolutely must evaluate your long-term living situation honestly. Reverse mortgages come with substantial upfront costs. We're talking FHA mortgage insurance premiums, origination fees, and standard closing costs. If there is a high probability that you are not going to stay in your home for a long time, perhaps you know you want to downsize in a few years or you're planning to move closer to family out of state, the upfront costs of a HECM simply will not make financial sense for you. You need to be confident you'll stay in the home long enough to amortize, or basically break even on, those initial expenses. And here is a major decision point based on these new 2026 limits. If your home is worth significantly more than the new $1.249 million FHA limit, let's say you live in a market where your home is worth $2 or $3 million, a standard HECM might leave way too much of your equity completely untouched. In that specific scenario, you might need to explore a proprietary jumbo reverse mortgage. But remember what we learned just a few minutes ago. Proprietary loans are not insured by the FHA. They do not automatically come with those strict federal protections for an eligible non-borrowing spouse. With a proprietary loan, the rules of the game are set entirely by the private lender, so you must read the fine print incredibly carefully.
Finally, we have to acknowledge the endgame. A reverse mortgage is not free money, it's a loan that eventually must be settled. It becomes due and payable when the last surviving borrower dies, sells the home, or moves out permanently. To illustrate just how real this is, official Federal Register notices show that HUD is preparing to sell over 1,165 vacant reverse mortgage properties, which represents about $352 million in loan balances in competitive sales just this year alone. These are actual homes where all the borrowers are deceased and no eligible non-borrowing spouse survived them. The loan life cycle just ends and the properties are liquidated to satisfy that outstanding debt.
As we look toward these sweeping 2026 changes, the landscape is clearly full of unprecedented opportunity, but it's also packed with rigorous new challenges. You have access to more equity than ever before, but the IRS is watching closer than ever, and the rules around property maintenance and spousal eligibility are incredibly unforgiving. So you have to ask yourself, are you prepared to safely unlock your home's equity with the right counsel and proper tax advice, or will you let the fine print catch you entirely off guard? Thank you so much for joining this explainer, and we will see you next time.